Hello, good evening, and welcome to Moneycontrol Mutual Fund Summit. This is the third edition of our Moneycontrol Mutual Fund Summit. I'm sure many of you all would have been here with us when we launched the first edition of our Mutual Fund Summit. Swarup, you were there. Radhika, Kalpin, you were also there. We launched this summit, the first edition, in December 2022. And I still remember the tagline that we gave that year was from 40 trillion AUM to 100 trillion AUM. And I still remember when we gave that tagline, there were a few doubts internally expressed as to whether the 100 trillion figure that we're talking about or we're projecting the industry to be hitting in a few years' time from then on would be realistic or not. And I think you just need to understand the mutual fund industry, to be there in the industry, to observe whether from inside or outside, to understand the momentum that the industry had already started at that time. That was December 2022, 40 trillion. Today, we are sitting in August 2024, and the industry size is already 65 trillion. So we're well on the way the industry is on achieving the 100 trillion target. And the big story in this journey is the evolution and the emergence of the retail investor. And that can be seen in the SIP inflows that the industry has been getting. Last month in July, the industry clocked around 23,000 crore worth of inflows in mutual funds through SIPs. We believe that day is not far away when the industry will get 50,000 crore worth of inflows in mutual funds through SIPs. Now, of course, the industry has done a lot of good things, thanks to AMFI, thanks to industry players, all under the watchful eyes of SEBI. But one thing that we are all cognizant about is that in this journey, we are going to be getting a lot of investors, not just a lot of investors, but a lot of first-time investors, a lot of young investors, a lot of investors who haven't seen a bear market before. So is the industry equipped and mature enough to handle these young first-time investors who've never seen the bear market, to make sure that they don't leave the industry with a bad experience? That's the question that we'd be asking today on this panel, as well as our other two panels following. So, Radhika, let me start by asking you easy question, a big picture question. Very briefly, two challenges that you see. Of course, there are a lot of opportunities, but two big challenges that you see from this journey of 23,000 crore SIP to 50,000 crore SIP.
So first, Kezad and the entire Moneycontrol team, congrats on this summit. I think you started a tad bit late because I heard that there were supposed to be 250 people in the room, and there are far more than that. So I think in 3 years, the success of the summit is incredible to see. It's also a little tip-off to the popularity of mutual funds, so perhaps some of us can take credit, and I hope the rooms get larger as you do that. Two challenges that you asked me to talk about. So I'll narrow in on two things. I think in the last couple of years, there has been a lot of talk of so much liquidity coming into the markets. People are almost surprised at the size of this 23,000 crores, the number of young investors, all of this. And before I say challenges, I would say, one, we should not be surprised. In fact, Amarjit sir, when we were talking, we were talking about this whole noise on bank deposits and MF, and he said, finally, this is an outcome that one day we wanted. We wanted the mutual fund industry to compete with traditional instruments, and we should take some amount of pride in that. So this is good liquidity. And I do believe that this is just the beginning, because mutual funds and equities are still 8% of household savings. They've gone from 4 to 8, so we should feel happy. But the US is at 45, and it took a couple of generations. But that is the trajectory.
In our lifetime, will we see mutual funds becoming a dominant part of financial savings?
I think in our lifetime, there are reasonably young people here. I think we will see India have a 1 lakh crore per month SIP book. And I tell a lot of MFDs this. Now, two challenges. One is, I think, the kind of money, and I'm sure you will talk about it, knowing you, the kind of money that is channelized. So someone asked me off the record, are you worried about money coming into mid and small cap funds? I said, I don't want to target that. But I am worried that 40–50% of the new money comes into thematic funds. I've been a big advocate of a Dal Chawal school of investing. And I do think we are veering too much towards pickle and papad and chutney because all of us have lived this cookie enough. We know that for people to make money, they need to stay invested and they need to stay invested for a really long time. And investing in pickle and chutney doesn't do really well. So I think that's one. I think the second is we need to, and I know a lot of MFD friends are sitting here, a lot more continuous effort needs to be done to create more ARN holders. India has about 1 lakh plus ARN holders today. I think the country needs about 10 lakh ARN holders to take the mutual fund story to all parts of India and Bharat. You can do sachetization, you can do everything, but finally you need a lot more people to tell that story.
So fleet on the street.
Fleet, army on the street.
Army on the street, and you're saying money coming into, let's say,
the right things.
The right kind of products.
Dal chawal and army on the street.
Okay. Swarup, you know, you've hearing from the street, getting feedback from your team and speaking with distributors. When so much of money is coming right now at these levels, at Sensex, at where it is right now, so much of money is coming, so much of new investors are coming. What's your estimation? I mean, do people know that where they are investing the money? Do people know that, understand that, you know, markets can go up as well as markets can go down? Are they prepared for a market crash if and when that happens?
Kazad, first of all, thank you so much for inviting me to such a wonderful event as usual. Let me define this so much money. In the last 1 year, and let's stick to equity at this moment, and I'm giving some data, the industry AUM has gone up by 10.8 lakh crores. Net sales is less than 30% of that, just 2.8. That means 27–28% is too much money coming. 70% is market appreciation. That's reality, right? So when you define too much money, it's actually market appreciation more than sales. When you look at the 20–27%, bulk of it, 40% till last 2 years was small cap. And now we are seeing thematic, right? One is we talk about asset allocation, and I firmly believe asset allocation happens only in social media. In real life, it is brash return chasing that is happening. Data says it. I mean, Neil's there, so Neil's probably one of those beneficiaries of that 27% not having a small cap. We don't have a small cap, so we are part of the 70% of market appreciation in our growth. That's the truth. The net sales, thanks to some NFOs in the last 2 months, have actually gone ahead of the SIP book of the industry. That's the truth. So let's redefine this big money. Actually, big money is missed in probably one of the best performing markets of the month. And with passives now moving from 2% to 16–18% of folios in the market, I'm not talking about AUMs, actually index buying is also going up. So that's where is the big challenge that we are talking about. When we talk about mutual funds and the challenges or the infrastructure are two fronts. One is the fund management challenge, or building a good fund management infrastructure. And the other part, I think, is which Mr. Singh pointed out, is building a good infrastructure at the back end to see that money comes in and goes out very, very efficiently. If we can build this two part, because the market is expanding. I mean, when SEBI introduced the market cap linked categorization, I think between the smallest large cap and now to the 4-time increase, right, in market cap. While new stocks are coming, the market is expanding. My personal opinion was we could have done a lot more in the amount of money that could have come in. The average age of investors coming in is declining by the day. And my personal opinion is they're finding other avenues to invest rather than mutual funds is a reality. We just went to a fintech show this last weekend. I think there were more people in the Bitcoin and the derivatives stalls than in the mutual fund stalls. This is where the money is going. So we have to really think.
That bit has been sorted a little bit because of that.
I hope it gets sorted. I think it's great to see the regulator addressing it a bit. But I think in markets which are which people feel 25, 26% given by large cap funds as bad returns, then we have to do a lot of thinking.
My worry, Swarup, is that, when investors are investing now, when fresh investors, young investors are already coming into the markets, they are coming on the basis of past returns, they are coming on the basis of trends. So do they understand?
Guys, all of us, when we started as return chasers. As we grow, and Kalpen will bear with me in this because I'm getting into his zone, is that slowly we realize that it's a business of mitigating your risk. In the last 2 years, it suggests that it's just return chasing, and risk has gone out of the window. More often than not, I hear investors telling my risk profile has gone up. When I ask them, give me 2-3 instances why your risk profile has gone up, nobody has an answer for it. But time will tell. We've learned the hard way, so probably this will go through that same process.
So suppose if, God forbid, if the markets were to crash, we are talking about 23,000 crore to 50,000 crore SIP, but the SIPs can also dry up, the SIPs can also go down. Is the industry prepared for that?
No, I think let me put some things on this. I think regulatory-wise, we are more than prepared on this. And I'm not saying that because Mr. Singh is sitting here. I'm being very categorical here. The safeguard or the guardrails of the industry, and that's most important, right, are in place. And that makes this industry a far comfortable and safeguarded
from a confidence
perspective. How we manage the money is our job. That's our job. And I think over the years of managing money for 20, 30 years, the fund management is up to it. That I have no doubt on that.
Kalpen, just wanted to go a little deep into, since we've started thematic funds and sector funds, we were just looking at the trend of NFOs, the NFO deluge which has been happening in the industry. So we were just looking at some numbers. On an average, the industry has launched about 105 NFOs every calendar year since 2021, 21, 22, 23, and even 2024. We're still in August and we've already launched 112 NFOs. This is the total NFOs. Now, that's one figure. I'm giving you another figure. The collection of NFOs have been between 30,000 crore to 80,000 crore each in these calendar years. That's another second figure. And the third figure, the share of thematic and sector funds, absolutely astounding. In 2021, there were about 24 NFOs, which was about 24% of the overall NFO pie was in sector funds, thematic funds. Today, it has gone up to 59%. The collections in thematic and sector funds have also gone quite up. So why are fund houses launching sector funds and thematic? I'm not asking about you personally, but about the industry. If you can give us an insight as to at these market levels, why are fund houses launching so many sector funds and thematic funds? Is it only because SEBI has given you a leeway to launch N number of sector funds and thematic funds and only one fund per category, or is there more merit to it?
I think all of us, if you see, the mood is very heady. We are chest thumping. And we are only celebrating size. So if the environment is incentivizing size celebration, I think everyone is responding to that. That's my first comment. You asked why thematic funds. I think it's all interlinked. I don't think investor is buying a thematic fund or he's buying a sector fund. The investor is buying returns of the past in the belief that they are his returns. The returns of the past belong to someone who invested in the past. But I think as an ecosystem, we all have to reflect that we all start with returns. So when, let's say, you will also compare funds, it will start with returns. When media will compare funds, it will start with returns. When we talk about a new idea, we'll show that, see the track record, this idea has returns. So I think right from the birth, the only variable which has been taught to the investor is returns. So it's very unfair at times to say that the investor is chasing returns. But what else have we shown to him? Except for returns. That's my first comment. Why is the industry doing it? And I'm a part of that industry, and we are also doing thematic funds. But today we are launching the Nifty Top 10 largest stock index fund, which is what has not performed at all. So we are launching a fund today which has earned 1/3 of the rest of the market, because we believe that's relatively safer. So there are different strategies different people are using. Some are launching funds which they believe where the trends will continue. Some are launching funds which believe that the mean reversion will happen. We launched a banking fund 3-4 months back. We are not that happy because we collected only 400 crores and the returns have not come. So I think different strategies in different markets. And yeah, as you rightly said, the thematic category is very liberally open. So it allows for launching of more funds. So I think what Sir mentioned some time back, the role of responsibility and transparency and good conduct is a huge opportunity to highlight to our investors that if this is the theme we are launching, what is the likely risk for this theme? Because themes will always have risk. I was delighted when one of you, covered. We had launched a thematic old fund offer 4 years back of our infrastructure fund. It used to get me less than 1% of flows. The same theme today is very popular, where 9 subsections of that are coming out as an NFO. And today we are getting 20% in that fund. It's an old fund. It's a 20-year-old fund. So I think the important point is we need to highlight that markets have cycles. And, cycles means this too shall pass. In good times, we have to constantly remind ourselves and our investors this too shall pass. Be prepared for that. Likewise, in bad times, we have to remind that this too shall pass. Another interesting data point to add to what Radhika and Swarup mentioned. As of today, this whole SIP boom, 23,000 crores is the number we celebrate. But the net number is 8,000 crores. Why is no one writing about it? So we need to be conscious of that there are enough people who are also booking profits perhaps, or their SIPs are stopping and maybe, either they are rolling or not rolling out. And of this 23,000 crores, 3% of flows have come to hybrid funds. In today's environment, probably hybrid funds are the best products, multi-asset allocation funds or any hybrid fund, which is a balanced bouquet of, asset classes. But only 3% is going into hybrid funds. So I think, it's human beings finally evolution has taught us to choose funds basis past returns. It is a mammoth task to explain to investors that returns have cycles, returns will fluctuate. So moderate expectations.
But when the launches are happening, like our distributors and advisor friends tell us that on the side, fund houses tell distributors and advisors to be cautious when they sell their funds to investors. But on the other side, fund houses keep launching sector funds and thematic funds. So shouldn't it be your responsibility also as an industry to collectively...
So I can comment on my responsibility as DSP. We have learned that, if you launch funds at peak of cycle, generally experience is bad. And if you launch funds at low end of cycle, experience is better. In last 8 years, every fund launch of ours is governed by one question. Will I put my money in it or not? Will I put my mother's money in it or not? Will I put my chairman's money in it or not? And if the answer is yes, we'll launch a fund. If the answer is no, we'll not launch a fund. I can comment about DSP. Unfair on my part to comment about anyone else. And the challenge is, when we launch a fund in a low cycle, I'll collect 400 crores. I'll not get any headline that this fund collected 400 crores. I think the opportunity is to... So it's great that this question is being asked, but I think everyone has, their own antennas to take a call, what I want to do. So if a distributor is telling you that a fund is telling me sell NFO and then telling me don't sell NFO because it's overheated, he knows what he should do. See, we are claiming that the retail investor is not wise, but ultimately we have to take a call what is right to do, what is not right to do. Lastly, Morgan Housel has written a very powerful tweet today morning that, investing is 1 unit of data multiplied by 10 units of stories in bull markets. In bear markets, it's the other way around. So in bull markets, everything gets magnified with stories. So themes can, get magnified as stories. I was meeting someone the other day in the afternoon. He said that, there's a huge capex cycle which is going to happen. So we should make money. But how many people know that a lot of that gets priced in? And how many people know that capex cycles also will have cycles? It's a cycle, capex cycle. It's not secular. So I think we all are talking right questions. You're asking the right questions at the first level. There's a great opportunity now to go deeper. And the power is collectively in our hands to ask tough questions. You ask us questions that what can go wrong with your themes? So I think that's a great question to ask whenever an NFO is out or whenever a headline is written for a product or whenever a product presentation is released. Who should not invest? What should be time horizons? What is the past history? So when we relaunched our Tiger Fund, we highlighted that the infrastructure category since 2008, when India was supposed to overtake China till today, has delivered 4% CAGR return. The category of funds. So hot theme. So all I'm saying is that, at least I can claim, our intent is to launch cold themes. We don't launch hot themes.
Okay.
We launch cold themes.
Okay.
Kezad, can I make a request to you? I'm sure the others will agree. Since every year you ask us about return chasing, can you guys in media stop publishing the last 1 year return statistic? It is the statistic that does the most danger to investors, and I'm sure all of these guys are very responsible guys. Publish 5-year returns, publish rolling returns, which in my view, I mean, if I had to pick one stat to evaluate a fund personally, it would be 5 or 7-year rolling returns. Please don't rank funds on 1-year returns. We are creating what I call the sorting investor. He goes to a website, he sorts funds on 1-year return. And even if the fund says Radhika is a nice person fund and it's delivered 80% return, he or she will invest. So please, as members of the media, take that pledge not to publish 1-year returns. It will do.
Also, the fintech distributors, fintech websites also, they haven't, we'll get to that also.
आप शुरुआत करिए, बाकी सब follow करेंगे.
Okay, Ajit, you've been quiet for some time, so let's bring you in now. I want to take you back to your early days. And since we're talking about NFOs, since we're talking about thematic funds and sector funds, I remember your famous comment that the asset management industry is an asset gatherer rather than an asset manager. Do you still hold on to your thought?
Yeah, thank you for inviting me here. I think that, I remember, I'll go back a bit in history when Mr. Singh said that he's been working with SEBI for 30 years. I remember in 1988-89 when Dr. Dave was made the designated chairperson of SEBI, he set up a 4-person team to help create the mutual fund rules. And I was part of that 4-person team sitting in the IDBI towers in Nariman Point way back when. And I remember when we were writing the rules, we're talking about the net worth of what an AMC should have. And when the AMC net worth rules were announced, first 3 crores and 5 crores and 10 crores, and now became a big 50 crores and hopefully not 100 crores one day, it seemed to be, from a SEBI perspective, that large is good and small is bad. So you must have high net worth to be in the business. And I think the asset gathering industry has more than reciprocated that thought. What I hear and what I read all the time, and that's why I don't get invited to many places to speak, is that when you look at what's happening in the industry, it's about finding the product that is hot that will get you the AUM, as opposed to what makes sense for the investor in the long run. And I think if you looked at it from an investor's perspective, if you have 6, 7, 8 mutual funds on the equity side, that's all you need. Provided you've explained to an investor, and you've correctly mentioned, Radhika, that the press must play its role in terms of ensuring that people look at the 5-year rolling return or 3-year rolling returns number, not 1 year sort of, numbers which make no sense at all. But if you look at it from the investor side, there's such a FOMO, like a fear factor of missing out on this market boom, as opposed to getting the investor to realize their goals, recognize the risks that they want to take. Risks come first, returns come next. What we are talking about on stage and everywhere else has been about the returns of the industry. And I keep on asking, what is the risk? So at Quantum, for sure, I know we look at risk first. Then we decide, if you want this much of risk, what return can you get? And once you know your risk, you know your return. Here, what's happening in this whole return scenario of rolling returns, 1-year returns, and launching of funds, you're out there just getting AUM for the sake of getting AUM. Because like I said, if most investors need 6 to 8 funds, and we have 500, 600 funds out there, it doesn't make any sense at all. The other thing in terms of asset gathering is look at the small caps. We did a study of small caps. We will release it. It'll be a bit explosive, I guess, but we haven't yet. If you look at the top 5 small cap funds in India, it's absolutely frightening. Look at what their number of stocks were in 2020, 2021, 2022, 2023, and now. And look at the AUM growth and see what we call style drift. Just from the number of stocks, many of these funds had 50, 60 shares in the portfolio when they were small AUM, and they were small cap. And they built a track record. And based upon that 1-year track record number that we just heard, they started being sold these funds or started buying these funds for the return. Today, some of these funds have 100 to 200 stocks in them. They become the index. There's no chance they can outperform the index because there's a cost, there's an expense ratio, and you have to underperform the index. That shows the asset gathering mentality. Everything in life has a capacity. This room has a capacity. This bottle of water has a capacity. A mutual fund has a capacity. I've been requesting from SEBI for a long time that they should force every fund to declare its capacity. And what do I mean by that? What I gave the example of small cap funds, that after a particular size of AUM, you're not going to get the same track record that you purchased because you're going to behave differently as a fund manager. From having 50, 60 stocks, you're now going to have 200 stocks. We did a capacity study on the top 5 funds, and we found that one of them would have to reduce its AUM by nearly 95% to go back to its core thesis of what the fund was when it was smaller.
So Ajit, looking at that, listening to your response on that question, I just wanted to highlight a few themes. Now, put your fund manager hat on. And, you know, manufacturing fund, innovation, 7 new funds were launched in manufacturing, 5 new innovation funds were launched, 13 new banking and financial services funds. There's a defense fund also. Auto funds, 4 auto funds were launched last year. So aside from the fact that so many NFOs are being launched, especially in thematic sector funds, can you just briefly tell us as to what is the longevity of these kind of themes? I mean, are they all weather, as in, you know, do they have sustainability?
So, you know, launching thematic funds, from my experience, managing money globally, managing money in India has been a non-starter. You're not going to win because you're buying a cycle. And unless you're very smart and you time that cycle of that sector, as you mentioned, you buy it when it's cold and you sell when it's hot. The question is, will you be advised? Will you as distributors and financial advisors, will you advise your client at that point in time to sell when it's hot? And how do you know that it's hot? Because the fund manager is still saying it's a good place to be in. So I think thematic funds and these sort of funds to me are completely no-no. Total no-no, in my opinion. And I'll go back to one more point, which is the liquidity. We talk about the net asset value. The definition of net asset value is, if I redeem, I should be able to get that. So if the share price, if the NAV is 100, when I give that redemption at 2 o'clock, 3 o'clock, I should get 100 back. But if many, many people redeem on a particular day, and there's a run on the fund, if you will, at the end of that day, particularly for small cap funds, there's a very high probability that the NAV will be sharply lower. Some of these small cap funds that we've analyzed in their top 10 holdings, it'll take them 3,000 days of trading to exit a top 10 position. There are 220 trading days in a year on average. That's nearly 15 years to exit a top 10 position. And the average for these funds is between 80 days to 100 days. So I know that SEBI has come out with a liquidity criteria, and this is to ensure that investors, advisors, distributors recognize and let their investors know that NAV may not actually be the NAV they get. And for those of you all who were around in September 2008, please recall what happened to small cap, mid and mid cap funds. There were very few small cap, mid cap funds in 2008, but their NAVs fell by 60 to 70% in a few weeks. Go back in history, look at the charts.
The big warning signs from Ajit. Swarup, I want to bring you in on, and you and Radhika probably, on this, the other emerging trend, which is seen between this journey of 23,000 crore, 50,000 crore SIP inflows. When we are talking about SIP, now there's more talk coming in the industry about micro SIPs. Of course, people invest 5,000, 10,000 rupees every month in SIP, but now there's a call for investing small size SIPs, sachetized SIPs, 500 rupee SIPs, 700 rupees SIPs, which is fine. But what is the longevity in your, I mean, you've been in this industry for so long, and I'm sure you would have seen patterns of people coming in and coming out, going away. What is the longevity really for people who invest just 500 rupees, 700 rupees SIP, would they ever see a big gain in their portfolios to be there for the longer term? Is there anyone to advise them? Because most of these people come through online channels where there is hardly anyone to explain them to stay invested in the long run. So flip side of these sachetized SIPs which are being talked about, how can they be made better?
Kaizad, at a macro level, let me make a statement, okay? I firmly believe that we are a room full of long-term investors now, 10, 15 years in the industry, making extremely short-term investments. That's data. Nobody is there for more than 2 years is reality. Whether it's through the SIP route or lump sum to khatam hai bazaar mein. Because people are now using SIP as a timing tool. While SIP is a cash flow solution, right? If you don't have money per month, you invest. But the moment you convert a lump sum into an SIP, you are timing the market, nothing else, right? STP is a timing tool, right? Nothing wrong, nothing right. But when you look at the data, and Kalpen kind of referred to that 23,000 coming, and bank data 8,500, though I believe some data is wrong in that, because my personal opinion, I have no data to refute it, is that if a redemption happens in an SIP, the entire SIP amount is getting, otherwise 12, 13,000 stoppage is a little, keeping that aside. Fact is, there are enough SIP stoppages happening, and that will happen. See, I'll give a very small example. For the last 2 years, 3 years, none of those NFOs have come from our side because we don't believe in those areas. We've highlighted some of the valuations in the market. In the 70s, when Gavaskar was facing those fearsome 4 bowlers, he was asked what is the best way of facing the quadrat. He said from the non-strikers end. And we're playing the last 2 years practically from the non-strikers end. Ball is swinging dramatically. We've not agreed with it. And since there's a market valuation growth, we've grown with it, right? But since we don't have a small cap, our SIP book has not grown, is a reality. So if you are going to accumulate a volatile asset in your portfolio, the redemptions are bound to happen. That's what is happening at this moment. Little crack, there'll be a stoppage.
But micro SIPs,
coming to your micro SIP, I'm all for sashaying anything. But we have to think investing 250 rupees in today's economy, kitna gain hoega? 500 rupiya mein ho jayega, kya farak padne wala hai uske life mein? While our job is to provide avenues of investing, it's up to the distributors and the investors to make a meaningful investment. Today, it's a reality that a person does not need to justify why he or she wants to buy a new phone in the second year, but starting a 5,000 rupees SIP needs a lot of discussion, rolling returns, 1 year return, all that comes. So, till the need of investment is not risen, I'm all for opening it up, no issues, we should be giving, but we have to think, if you invest 250 rupees and it becomes 750 rupees, what meaningful change is going to happen to a person's life? Is where we come from. Is that an asset allocation, or is that really the need of the person's investment is where you have to come from. So opening this up, making 100 rupees, we have not done it, 100 rupees minimum application size are avenues for investing. If it makes a meaningful change to the person's life, one should, but you have to think twice.
Radhika, there's also the problem of cost. We were checking the costs of setting up an SIP, uploading the KYC documents, registering KYC, everything has a cost. Do micro SIPs really work from a cost perspective also? I mean, Swarup has said that it's okay to open up, but unless we launch meaningful products and there's somebody to handhold the investor, the 500 rupee or 200 rupee SIP won't grow too much.
So let me give you my two-part take on this. Today, many fund houses, including us, already have platforms that say you can do 100 rupee SIP, 250 rupee SIP. I don't know if some guys, I think someone did a 10 rupee kind of thing also. Now, the reason people don't promote it enough is because costs are prohibitive. Between RTA cost, NSDL cost, and all the lamba chitta of cost, nobody may, and if that SIP is lasting less than 2 years, God forbid, as Swarup has said, nobody is making money on a 100 rupee SIP. So the reason I am excited about the micro SIP initiative and, you know, the fact that it's being pushed is it will finally focus us to reassess variable costs of doing business in the MF industry. This has been one of my sayings for the last 3-4 years that, you know, an increasing amount of us, you know, margins are coming down, by the way. We are a newer asset management player. Everyone knows equity fund margins now are 40-50 basis points at max if you don't do NFOs. If you don't do NFOs, then Swarup is raising eyes, and then I am not saying we don't. So if you don't do NFOs and you are a reasonable person, उससे ज़्यादा margin होता नहीं है, right? But I don't think RTA costs, custody costs, anything has come down. I run the largest debt passive book in the country. I think we make management fees of 7-8 bips. The RTA fee is probably 2-3 basis points. So the reason I'm excited about this is it will call for an entire cost review of the AMC ecosystem, which is very, very good. I think costs of doing business are very, very high. The second point that I would add to what Swarup made is, I don't know, you already have, I read a statistic, 50 crore Indians that pay 100 rupees a month to Netflix or Amazon Prime. I'm assuming they can already do a 100 rupee SIP. I'm not sure if they need to make it lower, right? Because if a consumer can pay 100 rupees to Netflix, I'm sure he can give 100 rupees to Edelweiss Mutual Fund or Mirae Mutual Fund or whatever it is. The other thing you have to think is, so if with this micro SIP, you are catering to a consumer that is just about able to invest 100 rupees, what is the financial literacy of that consumer? Now, if that consumer is coming via your direct platforms, then they are the sorting investor who's picking the highest funds and then is going to go into thematic funds. That, in my view, is extremely disastrous for that consumer. Or you have an advisory infrastructure that can cater to that kind of consumer. So my worry is, are you ready to service a consumer with that kind of financial literacy?
Kalpin, we are running out of time, so I just have 2 more rounds of questioning to go. First round to you. This other concept of, when we are talking about investors coming in through SIPs, investors coming in through mutual funds, zero folios. That's something which is there in legacy fund houses such as yours. People who may have invested in your funds and then withdrawn, may have gone elsewhere. So is there any effort being done in the industry to get these investors back into the fold very quickly?
Sure. Yes, of course. We all keep writing back to our investors. So, as many investors we have with live folios, we have as many with zero folios. And this is precisely every 3-4 years investors come in and get out. So we keep writing to them. We write to them, we miss you, we love you, please come back. But email open rates are very low. And the only means of talking to them is via existing distributors who keep doing that, or those who are in direct plans write to them via emails. But generally, the hit rates are not, the best. And again, I think there's a huge opportunity. I was telling my team in the afternoon that we have to write to provoke him to come back.
How many of them do come back?
Our ratio is around 8% come back. But by the time they come back, some of the existing ones also leave. So I think it's like a train where people come in and go out. And that's an opportunity to write to them in a way to say, पहली बार में 2 साल के लिए मत आओ, 20 साल के लिए आओ.
Okay. Ajit and Swarup, I want to move to you all for the last section, this thing about risk and about internal mechanisms to sort of, safeguard investors from any accidents that could happen. So one, Ajit, give us a sense of how much fund houses invest in strengthening the risk departments. When you, when you hire fund managers are always celebrated, sales and marketing officials. When you, we were looking at the salary levels of some of these, fund houses, public disclosure, obviously. Only in some of these fund houses did I see a chief risk officer's salary being among the top echelons of the people who are earning salaries. And in some of the fund houses, I did not see the chief risk officer's salaries. Does that mean that fund houses are not investing enough or empowering risk officers to basically ask questions or, hiring people of that caliber? What are fund houses are doing in...
Well, quantum is different, I guess, from the breed in many ways, because I think in our perspective, risk starts with the fund manager himself or herself asking questions about the stock they're about to buy and the company they're buying into and the governance issues that come around that. What you're talking and what we have is a chief risk officer who looks at the risk of the enterprise, right? What will happen if money flows out, you get redemptions, costs go up, SEBI rules change. We look at that risk. We don't look at... So volatility, the up and down movement of a share price is not risk in our opinion. In our opinion, as fund managers at the parent company Quantum Advisors, PMS, and Quantum AMC, Risk is buying into badly governed in firms. Some of you may know we filed a case against ICICI Bank recently. In fact, we got a judgment today, and apparently we've lost. I've not read the judgment. But basically, we did that because we believed that ICICI Bank was taking over its listed subsidiary at a price that was too cheap. And we did not want to go to court, but they wanted to ram it through NCLT, so we put our foot in the door and started fighting on behalf of our unit owners, and all costs of the legal come to the AMC. So that's again an issue with the SEBI thing. But so there, the risk was that ICICI has changed after the change of management in 2019. That was the assessment of risk. And what actually happened is that we believe actually it's still risky. So there's an enterprise risk, which is different from the risk to our portfolio. And we recognize we made a mistake. We wanted to stop it. So far, the courts have ruled against us. Let's see what happens. But we think of the ICICI case as a complete breakdown of governance across the spectrum. And if you ask me the biggest risk for India, it's not mutual fund sahi hai. Mutual fund is a phenomenal vehicle. The question is what happens to those who are controlling the mutual funds? Are they really looking after the investor's interest? Or are they looking after their own interests as asset gatherers? And goes to the trustees, the proxy agencies. I mean, the whole spectrum is to be questioned, in my opinion. But I'll write a book on that one day. Thank you.
Okay. Swarup, last question to you. Sir spoke about, the setting up the internal mechanism to be able to catch mischief, front running, etc., etc. When we privately speak to fund managers or fund houses or CEOs of fund houses, they say, of course, these systems must be set up. The problem is getting the right caliber of people to be able to identify and catch these trends, to be able to monitor effectively. Is there enough happening over there? Do you get enough talent to be able to set up your internal processes? Will this be a success, the internal mechanism that AMFI has been coming up with?
Kaizad, I'm on print saying that I can lose my job on non-performance. I cannot lose my job on non-compliance. I'm a risk manager of this company. That's my job profile. Structurally, let me give you a brief. Recently, SEBI put in place that, you should have a trustee officer reporting to the trustee. We've taken it one step ahead and putting a vigilance officer reporting into the board. Both of them don't report to me. They're independent people who cut across departments, do whatever they want, and the entire office is available to them. Yeah, from a risk officer perspective, we identified a very young risk officer to take over the man. We believe he's excellent. And sometimes if you can see the risk meetings that happen and how he presents in front of very senior CIOs, sometimes I tell him, boss.
Which is what I always wondered.
Yeah.
Can your risk officers look into the...
So I was answering the salary part. Give him some time and you see the salary of the risk officer in my fund house, at least. But make no mistake, this is a business of risk. This is not a business of return generation. And people who graduate to holding the risk part of the business intact will prevail in the long run. It's been 16 years in India, not a single letter in any form from the regulator is something we take pride on. The last 3 years, we felt a lot of risks in the market. We've not agreed with the risks. A lot of people call us underperformers. We are completely comfortable with that. But if we are raising a risk call in the market, we will stand by that risk call, irrespective of who thinks with that, because that is the fiduciary responsibility. Time will tell whether we are right or wrong, but we'll hold on to the fiduciary responsibility as a job profile.
Can the industry do better?
I can speak for myself. But I can tell you this much, that upholding of the fiduciary responsibility as a criteria for selling a fund house is at a minimal. That's my honest submission in this forum. I don't think that's a tick mark in selecting a fund house.
Okay, so that brings us to the end of this interesting panel discussion. But before I let the four of you all go, I want to conduct a quick rapid fire, fun rapid fire, just for fun's sakes. So, rapid fire, Radhika, Kalpin, Swarup, and Ajit. One question, very quick answer. Radhika, let's begin with you.
Do we get a gift? If you're going to play Karan Johar, we might as well get a hamper, right?
Let me first hear your answer. Okay, so you are a shark. You are in the Shark Tank. There are 5 new AMCs which were launched recently. Bajaj Finserv, Helios, Old Bridge, Zerodha, and Samco. If you have to give your money to one fund house as a capital, not as a unit holder, which
as
one
as
would,
an investor.
which
Just
one
name
would
the
it be?
MCs again.
Old Bridge, Helios, Zerodha, Bajaj Finserv, and Samco. These are the 5 last AMCs which were being launched.
Bajaj Finserv, and you didn't ask me why. So Bajaj Finserv and that.
I can't ask you why? Okay. Okay, at least for your honest answer, thank
I
you.
give you an answer.
I can give a reason for that.
Okay.
You can read
give
my
it
mind,
now.
Swarup.
Please, please.
No, I'm a big fan of Nimesh as a CIO, so my money is with Bajaj Finserv, and I mean, Samir and I go back a long way, and he on stage claimed that we were the best fund house, so my money is also with Helios.
Swarup, your turn next. We know that you like music. You're often seen in music shops collecting LPs, record players, and records. If celebrity advertisements are allowed for mutual funds, who is that one singer or one music band or one group who would represent Mirae Mutual Fund?
Unfortunately, he's passed away. These 2 gentlemen, Kishore Kumar and R.D. Burman.
Ajit, tell me this very honestly. Would you rather be a fund manager or would you be a CEO come promoter of a fund house? Very honestly.
Fund manager.
Kalpen, last question to you before we hand over to the next panel. Your former business partner, BlackRock, is coming back to India. If you meet Larry Fink or any of the BlackRock mutual fund officials, what's the first thing that you would like to say to them?
Welcome back.
Okay, so thank you very much for all
Off
your...
the record, I tell this, it's not just BlackRock, but I see many global firms wanting to come back, including when I was in IDFC, we had Netixis. And they parted ways in 2014 because they said India is growing nowhere. So I keep telling them that at 15p, you exited India and went to China. At 25p, you're coming back to India and exiting China at 10p.
So stop blaming retail investors for return chasing.
Exactly.
Na?
No, but guys, leaving India is very easy. It's not the same on the comeback.
Okay. So on that note...
You always want the last word.
So on that note, thank you so much, Kalpen, Radhika, Swarup, Ajit. It's been fun talking to you. And thank you so much for being a patient audience. And we move on to the next panel now. Thank you so much.